March was a rough month for mortgage rates. They climbed nearly half a point, even though the Fed didn't raise anything. And if you're watching the market right now, that probably feels confusing. Because most people assume that when rates move, it's directly tied to what the Federal Reserve is doing. But that's not always the case. So in this video, I want to break this down clearly: what actually happened in March, why rates moved the way they did, where things stand right now, and most importantly, what this means for you if you're thinking about buying, waiting, or refinancing. Let's start with where we are today. As we enter April, the 30-year fixed mortgage rate is sitting around 6.25%. The 15-year fixed is closer to 5.75%, and depending on your situation, there are still alternative options. Adjustable rate mortgages, for example, are hovering slightly lower. FHA loans are also coming in a bit below conventional rates in some cases, so even in a higher rate environment, there are still ways to structure your financing depending on your goals. But numbers alone don't tell the full story, because what really matters is how we got here. So let's talk about what happened in March. There were three major forces driving mortgage rates higher. And understanding these three factors is key to understanding what might happen next. The first is global uncertainty. When there's geopolitical tension anywhere in the world, it creates ripple effects across financial markets. In March, uncertainty pushed investors towards safer assets. And one of the biggest indicators we watch is the 10-year Treasury yield. Mortgage rates closely follow the 10-year Treasury, not the Fed. So when the 10-year Treasury moves up, mortgage rates tend to follow. That's exactly what we saw. The second factor is inflation. Even though the Fed held rates steady, inflation is still a concern. And this is where a lot of people misunderstand the situation. The Fed doesn't just react to current inflation, it reacts to expectations of future inflation. So when inflation data shows signs of staying higher for longer, it reduces the likelihood of near-term rate cuts. And that puts upward pressure on mortgage rates. Even without any official change from the Fed, the third factor is economic volatility. We've been seeing mixed signals across the economy. Some reports show strength, others show signs of slowing. And when data is inconsistent, markets react unpredictably. That creates short-term swings in interest rates. So when you combine global uncertainty, inflation concerns, and volatile economic data, you get exactly what we saw in March: a rise in mortgage rates, even without direct action from the Fed. Now here's the key takeaway. If you're only watching the Fed, you're missing the bigger picture. Because mortgage rates are influenced by multiple factors, but the most important one to watch consistently is the 10-year Treasury. That's the real driver behind rate movement. Now let's shift into what happens next. The Fed is scheduled to meet again at the end of April, and naturally, a lot of people are asking the same question. Will rates go down? The honest answer is this: it's possible, but not guaranteed. There is still an expectation that we could see rate cuts later this year. But timing is uncertain, and that uncertainty matters, because while long-term projections may show a gradual decline in rates, short-term movements can still go in either direction. Most forecasts right now suggest that rates will stay within a range of about 6.0% to 6.5% in the near term, with a gradual downward trend over time. But again, that doesn't mean a straight line down, it means movement. Ups and downs along the way. Now this is where things become practical, because understanding the market is one thing, knowing what to do with that information is another. So let's talk about what this means for you. If you're actively buying right now, the most important step you can take is getting pre-approved. Not later, not when rates drop. Now. Because pre-approval does two things. First, it gives you clarity. You know exactly what you can afford. And second, it puts you in position. When the right property comes up, you're ready to move. And in today's market, speed matters. Now, if you're on the fence, this is where mindset becomes important. A lot of buyers are waiting for the perfect rate. But here's the reality: perfect timing rarely exists. Rates may drop to the mid-5% range later this year, but they may also stay closer to 6.5% longer than expected. And while you're waiting, home prices, competition, and inventory are still changing. So instead of waiting for perfect conditions, the better approach is this: buy when the monthly payment works for your situation. Because that's what you actually live with, not the rate alone. Now, if you already have a mortgage, especially one above 7%, This is a different conversation. Refinancing activity is already picking up compared to last year, and depending on your numbers, there may be an opportunity to lower your payment or improve your terms. But again, it comes down to your specific situation. Running the numbers is what matters, not guessing. Now let's talk about one more strategy that often gets overlooked. Rate locking. If you're within about 60 days of closing, locking your rate becomes an important decision. Because at that point, you're close enough that small fluctuations can impact your final numbers, and trying to time a slight dip can be risky. Sometimes protecting your current rate is the smarter move. Now let's bring everything together. March showed us something important. Mortgage rates don't move in a straight line. They react to global events, inflation expectations, and economic data. Not just the Fed. Right now, rates are around 6.25%. And while there's potential for them to move lower over time, short-term volatility is still part of the market. So the question is not, will rates go down? The question is, what makes sense for you right now? Because real estate decisions are personal. They're based on your budget, your timeline, your goals, and your risk tolerance. Trying to time the market perfectly is incredibly difficult. But making a smart, informed decision based on your situation, that's what creates long-term success. So here's the bottom line. Rates will move. They always do. But the smartest strategy is not waiting for perfection. It's understanding the market, knowing your numbers, and acting when it makes sense for you. I'll be breaking this down again next month, especially after the Fed meeting. And if there are major changes, we'll cover exactly what they mean for you. So if you want to stay updated and make smarter decisions in this market, follow along. Because the more clarity you have, the better decisions you can make.